o'clock. I try to be as punctual as possible because I like to respect everyone's time. So I'm going to start with today's topic. Before I do, are there any questions or any comments? No, I'm free to go. Perfect. So tonight we're going to be talking about fixed versus variable rate mortgages and crunching the numbers. So I have a couple of scenarios that I'm going to bring up on if it's better to take a fixed or a variable rate mortgage. This is the question that keeps coming up, especially in the last, I would say, the last 3 to 4 months, and predominantly with people who are in a good financial situation. Even though variable rates are higher, they can sustain it. But shortly, we're going to see that the gap between fixed and variable rate mortgages is going to decrease, and we're already kind of seeing that in the field. Before I get into the fixed versus variable rate and crunching numbers, I wanted to go over just some basic terminology when it comes to mortgages. I like to do this because, especially if we've owned a home for a long time, you get, and if you've owned a home for a long time and you've always just renewed with your bank, you might not necessarily understand all the terms. And if you're 10 years in as a homeowner, you kind of feel embarrassed because you've owned a home for 10 years, you've had a mortgage for 10 years, but I don't know what a term is. I just know that I receive a renewal at the bank. So I'd like to go over just some of the basic terms so that we're all on the same page. So what is a mortgage? Basically, a mortgage is a loan using a real estate property as collateral. So most of the time, we don't buy real estate cash. We usually need some type of loan in order to make that purchase, and that's what a mortgage is. Before, I believe, I want to say the late 70s in Canada, there was only one big long kind of amortization period. So an amortization period is the entire length of your loan. In Canada, the most typical amortization period, if you're purchasing a property for the first time, is 25 years. You can go up to 30 years and up to 35 years possibly. And it was kind of mentioned last year during the National Mortgage Broker Conference that one of the provinces is thinking of introducing 40-year mortgages or reintroducing 40-year mortgages as a test pilot. I believe it's this year or next year. I can't remember. Back in the day, there were 40-year mortgages, but that was abandoned in around 2008, 2009. So 25 years is the most common amortization period. And like I was saying, back in the day, there were no terms. It wasn't divided up into terms. Whatever your rate was your rate for the entire term. After the late 70s, early 80s or so, terms were introduced. So basically your whole amortization period is broken down into terms. The most common term is the 5-year term. And what that means is that your conditions of your mortgage are locked in for 5 years. It's contractual. There are other terms. There's 1 year, 2 year, 3 year, up until 10 years. But again, the most common term is 5. In the last year and a half, 3-year terms became popular because of how the interest rates were going, and a lot of Canadians were opting for the 3-year rates because they're thinking that mortgage rates were going to come down. So again, a term is basically locking in the terms of your mortgage for 3 years, and every 3 or 5 years, whatever your term is, you get to renew based on what the market conditions are at that time. So that's amortization period. Types of terms. There is also something called an open mortgage as well as a closed mortgage. The majority of mortgages are closed, so the terms are fixed. And if you want to break those terms, if you want to break a term, like if you want to break your contract in the middle of the term, there's some sort of penalty that you need to pay depending on what type of mortgage you get. With an open mortgage, it's like going from month to month. So there is no penalty to break it. However, the interest rate is usually higher, and most people don't tend to don't choose an open term unless it's a strategy. So for example, you're thinking of refinancing, you're at the end of your term, but you're kind of negotiating with different lenders, so you're not sure where you want to go. So you want to keep that open term for maybe a month or two until everything is done, until you finalize the new term of your mortgage. But like I said, the majority of mortgages in Canada are closed. Here are the conditions for this amount of time. Now the fun part and the reason why everybody's here, fixed versus variable rate mortgages. Fixed rates are pretty straightforward. I am the bank and you, Salson, need a mortgage. I'm offering a rate of 5% for the next 5 years. So fixed rate mortgages means that you're locked in at a certain rate for a fixed term. So during that time, no matter what happens to the rate, your payments are going to stay the same. Your mortgage rate is going to stay the same. Most Canadians prior to COVID liked the 5-year term fixed rate, so the 5-year terms. That was the most popular type of mortgage. When COVID happened and interest rates started dropping, variable rate mortgages were more exciting because those were the ones that you saw that were in the 1% and everybody wanted to jump on board. So variable rate mortgages go up and down. They fluctuate based on the Bank of Canada's rate announcements. The Bank of Canada controls the flow of money in Canada, and 8 times a year they announce what they're going to do with their benchmark key lending rate. So basically, any type of variable rate loan across the country depends on that announcement. For the longest time, our variable rates were kind of steady. Even the fixed rates were kind of steady, but during COVID, everything kind of went out of whack. So in the beginning of COVID, what happened is that more and more people were interested in the variable rate mortgages. They were less scared because rates dropped. Typically, when it comes to mortgages, especially when you're talking about your principal residence, like the home that you own, typically people like to know what their payments are going to be, and they don't like surprises. They want to know every month I'm going to pay $1,500 a month for my mortgage. That's all. I don't care if it's a little bit more. Variable rate mortgages were less exciting because a lot of people feared, well, what happens if rates go up all of a sudden? Variable rate mortgages, like I said, they fluctuate with the Bank of Canada's rate announcements. So that was always a possibility, except that it really didn't happen until like 2022. Right. So during COVID, a lot of people jumped on board with the variable rate mortgages when they were very low. And then all of a sudden in 2022, they shot up. And there are people who are in a situation where they're paying a lot more on their mortgage payments because of that. So why did people pick fixed rate mortgages? Like I mentioned, people like to know their payments. However, historically, minus this brief period of time that we're experiencing, historically, on average, over the lifetime or the entire amortization period of a mortgage, historically variable rate mortgages beat fixed rate mortgages. But the fear is always what happens if rates go up. And that's exactly what happened over the last couple of years. That was the fear that everyone experienced. But again, prior to that, if you looked over historically, variable rates on average always beat fixed rates. So if we're talking about now, if we're talking about whether you're purchasing a home now for the first time or your mortgage is up for renewal this year, the question is, which should I go with? So I'm going to mention today's rates, and again, this can change at any time. Well, the variable is pretty steady, but the fixed rates could fluctuate. Let's pretend you're a first-time home buyer. A first-time home buyer, a very common situation that I see right now are, I'll get a couple, they make $150,000 a year combined. They have no debts. They have a down payment. They could typically qualify pretty easily for a property with a $500,000 that costs $500,000. So a $500,000 purchase price, and they're able to put 5% down. So that situation, $500,000 purchase price, couple makes $150,000 a year, no debts with 5% down. If they choose a fixed rate mortgage today, 5-year fixed, currently you're looking at about 4.9% for a 5-year fixed rate. That comes out to a mortgage payment of $2,856 a month. That includes the mortgage default insurance premium in this situation because these clients are putting less than 20% down. If we compare that to the current variable rate mortgage, variable rates right now are 5-year are about 6.25, so 6.25. The mortgage payment on that would be about just about $3,200. So you're talking about a $400 a month difference in cost. The question is, why would someone choose to go with a variable rate if it's $400 more expensive? The person who would choose to go with a variable rate mortgage is thinking that variable rates are going to go down below 5% or 4.9%, below the fixed rate, sometime before the next 5 years. Can we tell you if it's going to do that? No. There's a lot of economists, there's a lot of articles that are going to be published. We predict that. But nobody's going to know. And when it comes to your own mortgage, it's something that you have to kind of decide based on your risk level. But to answer the question, why would someone choose a variable over a fixed rate now today when there's a $400 difference between the two? It's for that reason. It's because over the next 5 years, do I believe that the variable rate will go below today's current fixed rate? Now, if let's say not too long from now, the variable rate drops to 5.5%, all of a sudden the mortgage payment will be just over $3,000. So now we're talking more of like a $200 difference a month. And if you're a couple, you're 2 people, and you're splitting costs evenly, that's an extra $100 a month, which for people who are in like a good financial situation really isn't the end of the world. If you're somebody who's tight, if you're paycheck to paycheck and you're just making ends meet, might not be a good idea, even if there's that possibility that interest rates on the variable side might drop down. Okay, so should we choose a variable versus a fixed, or a fixed versus variable? I always go back to what's the best for your situation. I ask a lot of questions to clients when I meet with them. I never decide for them, because what I might endure or what I might be able to take might not be what like Tusa or Elaine could handle. All of us have a different risk factor level, and we also have our own personal situations that we have to deal with. Again, prior to 2020, Canadians were just automatically choosing 5-year fixed rates, even if it was more expensive. So now on the flip side, we're looking at fixed variable. The variable rate does have that, it does have that possibility of dropping, and we hope, and if you ask my opinion, hoping by the end of the year it'll drop by 0.5%. 0.75% would be excellent, but I'm not the one who makes the decision. But that's that's kind of what we're saying. But that's the dollar difference. And whether you're purchasing for the first time or your mortgage is up for renewal, that's the dollar difference between the two. And the question you need to ask yourself is, number one, could I sustain this, this difference in cost for my payments? And number two, how do I feel about mortgage rates going down, and when in the next 5 years, if that's the term that I choose? Because that's really the question that you're asking. If you say to yourself, oh, I don't think they're going to drop under 5% in the next 5 years, then go with a fixed rate. But if you do, then it might be a good idea to look into the variable, because on average over the 5 years, you're probably going to win. But it is a personal choice, and it also depends on your personal situation. Another question that I always get is it better to pay biweekly, or is it better to pay monthly? Again, it's a personal situation. There are some people from the school of thought where I want to pay off my mortgage as quickly as possible. And other people just want an affordable payment. And these are options that can change over time throughout the entire span of your mortgage. Basically, a monthly payment is very simple. It's one payment a month. Bi-weekly, it's one payment every 2 weeks. But how it's calculated is that it's your monthly payment multiplied by 12 and then divided by 26 because there are 26 pay periods, if you want to call it, in a year. Accelerated bi-weekly is also a payment every 2 weeks, but it's calculated as a monthly payment divided by 2. So with both biweekly and accelerated, you're making an extra payment, but with accelerated, you're paying a little bit more. So just keep in mind, you're going to hear a lot online that it's better to pay biweekly. Look, it's not a question of better. Yes, you're going to save on interest. Yes, you're going to pay off your mortgage a bit faster, but can you sustain the payments? Because these are higher payments. So it goes down to personal situation. So I think I've covered everything. Oh, there's one thing that I did want to mention when it comes to variable rates. There are different types of variable rates. So one type of variable rate is, well, the regular variable rate mortgage is basically your payments fluctuate if the Bank of Canada's overnight lending rate also fluctuates. So your rates aren't guaranteed. The other type of payment, variable rate payment, is a static payment. So your payment remains the same, but at the end of your term, it's adjusted based on what happens with the variable rate throughout your term. So it's possible that you might have to pay to make up that difference. Not all lenders offer both types of variable rate mortgages. This is something, if you're working with a mortgage broker, that you would need to mention to them. If you're working with a mortgage specialist at the bank, this is something that you'd want to express to them if one is more important than the other, or if you have a preference. There are many, many different types of mortgages out there. It's really important to ask these questions. It's also very important for the person that you're working with to ask you these questions, because there is no one best mortgage. Like if you're a real estate investor, for example, you might prefer a variable rate mortgage even if the rates are higher. Why? Because if you ever have to break a mortgage because you have to refinance or you need to do a quick sale, the penalty is much less than a fixed rate mortgage. So real estate investors in general, if they're not sure if they're buying and holding, they tend to take variable rate mortgages. And when it comes to the interest, they don't care because it's a deductible when they file their income taxes. So it just comes off as a business expense. So I believe that's everything that I wanted to cover. I know I shared a lot of information. Does anybody have any questions?